Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Much of the equity trade so far this year has had an international flair to it. As we enter a week of significant bond auctions for U.S. debt, flavored by a difficult deficit backdrop, the headlines likely will be powered by the international trade agenda, both across the oceans and actually here at home. So how do investors get set with some new portfolio discussions that bring asset allocation for a new era to the fore? The man who has been thinking through this question over the past weeks and has illustrated it for you joins us now, armed with charts and graphs that tell part of this market story. We're pleased to be joined by Fidelity's head of global macro, Jurrien Timmer. Hi, Jurrien. Great to see you. Welcome.
Good morning, Pamela.
Fantastic to have you join us. I think from the West Coast. Salutations.
Yes, I was just in Vancouver. Saw a lot of our loyal followers and watchers. So it was great to chat with so many people. And on my way to Salt Lake City this afternoon for another event. So I'm wedged in California in between. So
we're delighted to catch you then, because that is actually kind of wedged in. Okay, so wild, interesting times in the markets. There is still very much a feeling of just about all-time highs. Recovery is here. We're sitting amidst it. Why are we worried?
Well, there are two big elephants in the room, and not just one. So obviously trade is the big one. And, many conversations I had in Vancouver at the convention center with clients, we're around kind of, what happens next? There's very little visibility, of course. Markets don't like a lack of visibility. Investors don't like it either. And obviously what happens on the trade front, do we get a trade war, or is the worst behind us? Has the market sort of correctly discounted a lot of the announcements that come out of the White House now that it knows that the markets can push back and actually maybe win the battle? Or is there another round to come? And we don't know. We're in that reprieve period in terms of the reciprocal tariff. So we wait and we see what kind of deals are cut or not cut. Mm-hmm. And obviously you all in Canada are at the forefront of that. But we can't forget about the other elephant in the room, which is this period of fiscal dominance that we are in, not just in the US, but around the world, where we have, aging population, slower growth, but rising deficits, and no support in funding those deficits from central banks, at least not in the US, but almost nowhere now. And the question is, if there isn't a price insensitive buyer for that debt, as the Bank of Japan has been for a long time, what happens to interest rates? What happens to bond yields? What happens to the term premium? And if the term premium goes up, forcing bond yields up, what does that do to equity valuation? We go back to the whole Fed model discussion. And so, and then the follow-up question again, which was asked very often, is, okay, what does that mean to our asset allocation paradigm, right? The 60-40, is it dead? Because the 60-40 relies on a negative correlation with bonds, between bonds and stocks. And if that correlation has flipped positive, which it did in 2022, does that change how we think about investing? And I think the answer is yes. And we spend a lot of time talking about the 60-40 becoming maybe a 60-20-20, where you rely on more uncorrelated alternative assets to kind of help diversify in a portfolio that is still anchored by the 60, by the equities, but maybe that 60 is more global and less US. So those were kind of the themes that we discussed.
Because ACWI, which measures, this is sort of the international benchmark, and the US equities within it make up an enormous amount. You'll tell me how much, I can't remember, but it's overwhelmingly US equities. But that is shifting also, isn't it?
Yeah. So why don't we go through a couple of charts here? So why don't we start with slide one, and we'll just kind of unpack the last week or so of data, and then we'll get into the international question. So again, this is the roadmap of what happens after the S&P falls 20%. And what you can see is we've had one of the most impressive V-shaped recoveries
Wow.
ever seen. The only one that is actually matching perfectly still is the 2018 20% decline in the fourth quarter when Powell kind of, overplayed his hand, let's say, and he
Into
had to
Christmas
pivot.
Eve, that
And then we
trade.
had that.
Yeah.
Yes. And then we had that V-shaped recovery into 2019. So we're still following that. Analogs will come and go. It's impressive that this one is staying in place. It's acting actually better than I expected because I'm kind of in the camp of a range-bound market. But so far, we got to respect this, and that wouldn't be the worst thing if the market kept going on this track. But I don't really see that happening. But having said that, so let's go to slide 2. So last week, the S&P now has come within 1.8% of its all-time high set in February of this year. It hasn't been a great, like a high-quality rally, I should say. Only about 50% of the stocks in the S&P are above their 200-day moving average. And again, I'm still kind of in that trading range camp where the recent lows are the lower boundary, and my sense is that the highs, or the highs give or take 5% or so, are the upper boundary. But we'll see if that remains the case. But then we go to non-U.S. stocks, and the next slide shows the MSCI EFA index, which is non-U.S. developed markets, and that is a good-looking chart. Of course, it doesn't have the slope of the S&P because non-U.S. stocks have lagged behind for years. But this is a nice chart. You got 67% of EFA above their 200-day moving average. So you have good participation, which for an active investor is good because that means you have a pretty good pond to fish in terms of picking stocks that will win. And you've got, of course, new highs, very robust uptrend there. And so that's what we want to see. So this has been the story, of course, so far this year, where the U.S. corrected 21%, while the rest of the world actually went up. And not only did it outperform, but it actually went up in absolute terms. And just to answer let's go one more to slide 4. And this is the MSCI All Country World Index, or ACWI as we call it. Mm-hmm. And that is also making a slight new high, or at least it's back at the old high. It's a slight new high. And you can see that the money supply, the global money supply in the red line, is now growing at an 8% rate of change. And so this is part of the fiscal story that other elephant has a good side, of course. It means that governments are spending. It creates a fiscal impulse, higher liquidity. Markets do like liquidity. But the negative side, of course, which we'll talk about a little bit later, is on the bond side and what role they play. But let's go one more to slide 15. And just to your question earlier about how much the U.S. comprises of the world market, the bottom panel shows that at the recent peak, the market weight of the MSCI US versus the MSCI ACWI was 67%, even though the US's share of global GDP is only 26%. So that is a remarkable divergence. It's like we have a saying at Fidelity that whenever you see like a jaws chart where the jaws are opening, you wonder, how long it stays open and when it starts to close. And I don't have a crystal ball. I don't know if this goes on forever or not, but the U.S. market has significantly outperformed its share of global GDP. And of course, we know the story. That means it's because higher earnings growth relative to GDP, driven by the Mag 7 and other mega growers, higher margins. So you can explain this fairly easily, but it does show that this U.S. hegemony, this U.S. exceptionalism, has been running for a long time. And of course, the question we all want to have answered is, at what point does that jaw start to close, and does the non-U.S. Part of the world take market share from the U.S. in terms of the equity side?
Right. Okay. That is absolutely fascinating. Well, let's go into sort of the earnings question and the valuation question within there, because it goes to that, gosh, a lot of things got sort of pulled back, earnings estimates got chucked out and lowered. Did it go too far? As, again, there are elephants in the room, but we're also back up on the equity side to just about the all-time highs. So do we need such lower earnings estimates that we now have?
Yes. So let's go to slide 5. And just to start the conversation there, this chart shows the one I often show, which is the decomposition of the return in the S&P by earnings growth and valuation changes and dividends. Like those three things are the total return. And we're kind of in that that gray zone, right? Where like in 2023, we were in the first year of the bull market, right, which started in October of 2022. And as you can see, that first year was all PE driven, right? Earnings were actually slightly negative. So that was all PE, which is fairly normal because the market always recovers before earnings because, investors look ahead and discount the future. Then the second year, which was 2024, was both earnings growth of about 11% plus multiple expansion, amplifying those earnings gains. And that created that kind of outsized performance for the market. And so we've had two 20% plus years in the S&P. And now we're in 2025. And of course, it started with that 21% decline. Earnings growth is moderating now. It's the trailing earnings are about 10%, but starting to trail off. And the PE side is now sort of neither here nor there. It was down, now it's up. So we're kind of in that kind of late cycle feeling part of the market cycle. But if we go to earnings on slide 6, what we see, and which was natural to see, of course, was that during this tariff tantrum, let's call it that, earnings estimates were naturally marked down because, if tariffs are a tax, and that tax is going to be paid either by the importer via lower profit margins or by the consumer via higher prices, someone has to pay for the tax. And so if consumers balk at those higher prices and they don't want to pay for them, then it's going to come solely out of the margins of the companies that sell the product. And so that would mean less earnings growth. And you can see that that while Q1 was a very good quarter, that's the black line, Qs 2, 3, and 4 all have been marked down in terms of the growth rate by about 400 basis points. Now, they tend to get marked down anyway, because that's just how the drift works. You can see that in the chart. Earnings estimates start too high, then they move lower. But this was more than could be explained by the traditional drift. And so now we've had some more hard data in the U.S. We had a pretty positive, inflation report. Of course, the tariffs have not had enough time to push through the system yet, and they're only 10% at this point, so that's not a huge number. But the inflation reports so far have been very good. And the hard data around unemployment, we had the jobs report last week. That's still showing an economy that's holding up quite well. So now the question is, were the haircuts in earnings estimates premature? And if you look at the next slide, 7, you could argue that maybe that actually is the case. So in this chart, in the bottom panel, I show earnings revisions. That's the orange line. So downgrades, upgrades minus downgrades divided by the number of estimates.
That's a big drop off, isn't it? I mean, that was the minus 12, yeah.
Yes. So pretty big drop off, minus 12%. And then you see in the blue line, the financial conditions index. And that's holding up because the markets have rebounded, and generally speaking, things are under control. Like the Fed is not raising rates. The 10-year is still in its trading range at around 4.5. And so you could argue based on this chart that maybe earnings estimates might start to rise again. But again, we don't know how this story is going to end, right? We had that initial round. We all saw the big banner on Liberation Day with all the crazy reciprocal tariffs going up, 100% here, 200% there. That they've walked back from that with this 90-day cooling off period. But that 90 days is going to be over soon. And so we don't know what's going to come in its place. But that's where we have this relative calm right now.
But it is, as you're saying, that this 90 days, this is sort of the shorter term elephant in the room that we're talking about versus what also gets rolling today, or one of the pieces, is large bond auctions. This is, I think it's $22 billion worth, and many of them 30-year treasuries. So we're all watching yields there. That is something that will take quite a long time to unfold before us. What should we know sort of this week in that rather long story that we're walking?
Yeah, and I think this is the larger elephant, and one that we've talked about for some time now, even before the word tariff was uttered a few months ago. And so we go to slide 8. The big story, I think, of the last year or two, well, really 3 years since 2022, is that bond yields, long-term bond yields, are on the rise, not just in the US, but in Canada, in the UK, in Europe. You saw German yields rise when they got the wake-up call that they have to take care of their own defense spending. Japanese yields are on the rise. The only global bond yield that is not on the rise are Chinese yields. And maybe that has something to do with the fact that Chinese citizens or consumers don't have really any other good place to put their money because, the housing bubble there burst a few years ago. So we have the 10-year yield shown here, and we got sort of this fork in the road, right? You got a green line and an orange line there, and I'll explain what that means. The green line is my traditional Fed model, or bond model, I should say, that says based on what the Fed is expected to do, so the shape of the forward curve, and based on long-term changes in demographics and nominal economic growth, this is what the model says the yield should be. And the model says the yield should be 3.5. The other one is the same model, but it adjusts for a term premium that has been rising, right? We were at that's the bottom panel. We were at minus 146 basis points in 2020. We're at plus 83 now. And that makes perfect sense because we are in this new period of fiscal dominance where there's a lot of deficits and they need to be funded, and central banks aren't buying the debt, right? If you don't have those price insensitive buyers out there mopping up the supply, who's going to buy it? And so that upper model incorporates a return to a normal term premium, and normal, in my view, is around 150 basis points. And on that basis, the yield should be closer to 5%. And the recent action, we're still in this range, right, between 4 and 5. Let's say we're at 4.5. But to me, the bond market is following that latter pattern. And whenever the yield goes above 4.5, it creates problems for the stock market. It obviously increases the cost of deficit financing for the U.S., which is why President Trump has been, let's put it politely, calling on the Fed to cut rates. And so, but that I think is a more that's a lasting problem, right? And I'll show you my newest slide on slide 9. I made this chart yesterday, and to me, it's kind of a very simple but elegant way of describing the challenges that lie ahead for the bond market. I think the bond market is a viable asset. I'm not saying people shouldn't own bonds, but if rates are rising in an era where bond yields are competitive with equity yields, right? Bonds yield 4.5. The S&P, if you take the PE ratio of 22 and flip it upside down, you get a bond yield of around 4.5. So the risk-free asset is competitive with the risky asset. And when that risky asset gets cheaper, meaning the yield goes up, the equity market needs to compete with that. And that's a paradigm we haven't seen in a couple of decades, but we could go back to very easily as we did in 2022. So I'll explain this chart. So so we have a lot of debt, we have a lot of deficits, so that's not just a U.S. story, that's a global story. And the question is, how do you get out of debt? Obviously, austerity is one option, not very politically popular, I'll say that.
No.
And certainly not one that we're seeing. We had the little Doge episode, and that cut 175 billion, but that's a drop in the bucket compared to the deficits we're seeing every year of 6 to 8% of GDP. And so that debt level, which is the yellow bars at the bottom, continues to rise, and these are the projections from the CBO, and we're going to be at 140, 150% of GDP in the next 10 years or so. And that debt can be considered sustainable if the US can grow faster, right? So austerity is one, default is another. We're obviously not going to default on the debt. So outgrowing the debt or devaluing the debt in some other way through negative real rates or a weaker currency or what have you are the other options. So obviously the best option is to outgrow, right? And think of it as if you're an entrepreneur, you take out a loan to start a business and your business is growing faster than the cost of that loan, then that's money well spent. That was a good loan, and it's reaping benefits. And so that's the math. And Scott Bessent has been basically saying like, look, we're not going to cut the debt, but we're going to outgrow it. And so the simple metric is to look at nominal growth, which are the two lines in the top panel. As long as nominal growth is higher than your cost of funding, which is the 10-year Treasury yield, then you're okay. And generally speaking, like you look, for instance, in the 60s and 70s, the growth rate was above the funding rate, and even more recently, since the 2000s, 2010s, even today, the growth rate is above the funding rate. So as long as that continues, you can say the debt, I wouldn't say it doesn't matter, but it can be sustained.
Yeah.
The problem is that we've had a boost in nominal growth from the COVID response, and if you look at that chart, you can see that growth rate is going to come down from 6% to 4%. Now, 4% is below the current bond yield at 4.5%. So I think it's not an issue for today, but in the years to come, if that yield rises as the term premium gets priced back in and growth slows, then you're going to have a problem. And I think this is what really is the kind of the elephant here, because when you then go into looking at what happens to the dollar, for instance, and actually we can go to the next slide. The dollar is, so bonds are relatively well behaved right now. The stock market has almost fully recovered its losses. But here's the dollar sitting at the lows. Now, that's a tell. And it's sitting at the lows even though the interest rate differential between the Fed and almost everybody else except for the Bank of England is wide and widening. Yes. That's a tell, right? Because normally interest rate differentials will carry the day for currencies. So that means that someone out there isn't really that confident anymore that the dollar is going to do what it does. And maybe that story is related to the story I just told. So let me go back over to you.
No, these are amazing stories to tell within the market. There's one quick question on silver. I might just put you right out of that, the tell. It goes with gold, but quick thoughts on silver.
I bet you it's the same person who asked me the silver question in Vancouver.
Maybe.
Yeah, and you know who you are. Silver, so gold obviously is the other half of this story, right? If currencies and yields are moving one way, in my view, gold is the new long bond, right? And so gold has spoken, and it's speaking this exact story that we're telling. And Bitcoin is sort of along for the ride as well. And then silver has been moving in the same direction. Silver is a little bit, silver is kind of half industrial metal and half precious metal. It's a combination of the two. I mean, gold is industrial also, but it's primarily a precious metal. And so I would say that if gold continues to go up, which I expect that it will, silver will be along for the ride, but it has other characters to it as well. So if you had gold move up while there was a global reflation, then silver will probably go up more than gold. But right now, I think what's happening with gold is purely about hard money and not about global growth. And so I think gold probably shines the best, no pun intended.
This is a great question. It goes to the midterm discussion, not as in elections, but the midterm markets discussion. So if current presidential policies are reversed, Jurrien, are we likely to see a reversal in the downward trend in the U.S. market? I mean, we have seen equity markets obviously come up and bounce right back up. But what goes hand in hand with fixing some of these trade issues, policies, maybe in the near-term future? We're not sure yet.
Yes, we don't really know how this is going to play out. The thing that we do know is that they came out swinging. I'm talking about the president on that Liberation Day, again with that big billboard with all the very, very high tariffs that really shocked the market. That of course caused the tailspin in the markets. Then they walked back. I just imagine Trump getting a call from Scott Bessent saying, "Look, cut that out," and that was the markets essentially winning. That was the put being struck. Wasn't a Fed put this time. It was a fiscal put, whatever you want to call it. And I think that sets the range, right? Because now the markets feel more secure that they have a voice. And we can call the taco syndrome, I guess, not to be too spicy here, but that there's a sense in the market that they don't have to any longer react to everything that is said, because what is said one day can be unsaid the next day. So the markets are kind of tuning out a little bit, which is essentially what we did in the first term, but we didn't know that yet a few months ago, right? Markets were like, okay, this time he's organized, he's really serious, this is really going to happen. And so now we need to figure out how this 90-day holding period, how it ends, whether it's going to be more than 10 or whether this is the end of the story. And then you mentioned the midterm. We'll have a midterm election soon. Maybe that creates a more lame duck type of administration, just like the first one did. But having said that, tariffs, of course, are not really a congressional thing. So even if the House were to flip, I don't know that really changes anything on the trade side. If something happens on the trade side that reverses what we've seen, it's more likely to be just the market speaking or some kind of judicial overrule, but it's not likely to come from Congress. And I think that's also why this big beautiful bill, why they're pushing so hard to do this now, because the tax cuts would expire this year, but also you don't want to have that in a divided Congress. You want to push that through, which is what he did in the first time with the TCJA tax cuts. That was all right out of the gate. And then if you have a lame duck, it doesn't matter because you've already done everything. Yeah.
So interesting. And it's just a case of implementation at that point. Let's see if we can just fit this in. There's a question about whether there's still steam in the international equity trade. That's one. And I might just ask if you can put it with, you have a discussion about whether U.S. and non-U.S. markets actually converge and we start to see that happen. We've only got about a minute here, but I think it'd be a great note to end off on.
Yes. So let's go to 12. I'll be quick. So international markets are catching up, and you can kind of see that if you squint high enough. So this is U.S. market cap versus non-U.S. in the top, and the U.S. PE versus non-U.S. And you can see, they're very, very far apart, which means that there's a lot of room for catching up. The valuation difference, this isn't a bubble in the U.S., right? So the markets are very smart, they're very efficient. So the valuation difference you see has been justified. It's through higher margins, stronger earnings growth, higher payout ratios, and all of that stuff. So I'm not saying that gap shouldn't be there. The question is there now a catalyst to start closing that gap? And if we go to the next slide, you can see a chart that kind of compares the U.S., which is all the way on the far right, in terms of its fundamentals, right? So the amount of cash yield going to investors. So this is the payout times ratio times earnings. You can see the U.S. is the outlier. So if something were to happen fundamentally that diminishes U.S. earnings growth, maybe tariffs, right? Mm-hmm. Or while boosting international earnings growth, maybe through a fiscal impulse, then you can see that outlier come back into the pack. And that's how I see this, the jaws narrowing. Not that the U.S. is going to implode or anything like that, but that premium, that supremacy premium, starts to whittle down while the rest of the markets, the rest of the world starts to catch up. And I think that's how this mean reversion would work.
This is so fascinating. I always feel like we're getting a step ahead of what we're going to see play out in the market sort of this week and next. Jurrien Timmer, thank you very much for fitting us in. You're off to Salt Lake City. Good luck. Safe travels.
Thank you very much.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.